Welcome to Leaders in Lending. I'm your host, Jeff Keltner. This week's episode features my conversation with Anand Cavale, the EVP of Unsecured Lending at Guaranteed Rate. Anand had a long banking career at Citi, some time at SoFi, so he's got perspective from a bunch of different angles to provide on what's going on in the space today. And we really dove into some of the lessons he learned from the credit card business at Citi, obviously a business at quite a bit of scale. We dove into some of the newer trends in consumer lending, specifically what's going on in buy now, pay later, what might be happening in crypto, how to think about that. And I thought a really important conversation about how critical it is to understand consumer behavior in a deeper way when you're designing products, and how sometimes consumer behavior is not necessarily what you expect or what a rational, quote unquote, person might do. Really interesting perspective and very useful when you think about how you're designing your consumer journeys. So please enjoy this conversation with Anand. Anand, thanks for joining the podcast. I appreciate you making the time today.
Oh, welcome. It's a pleasure as well.
So I've begun asking pretty much all of my guests the same first question. So I want to start with that, which is like most of us didn't grow up dreaming of being in the banking space, being bankers or lenders or whatever. What was your path to end up here? How did you kind of end up in the banking space?
The honest answer is I was an industrial engineer, and my first job was at a iron ore smelting company. And the day I entered into my
Iron ore smelting.
yeah, and the day I entered there,
Wow.
it was 1100 degrees, making alloys. And I worked there for about 6 months, and within the first month, I figured out, this is probably not the best way to start a career. But I was at Honda when Honda started in India. But regardless, I think somehow my operations research kind of took the better half of my liking, and I tried to get into more of the management principles. I did my MBA, and I liked that course, and I ended up in a bank with Citi for quite a long time. But I knew that on the engineering side is where I want to be. So that's the 100% of the answer.
Yeah. Well, how do you see the value of an engineering? I mean, I've got a computer engineering degree, so I have my own perspective on this. But the experience of having done real professional work as an engineer and having an engineering background in the context of a non-engineering business or company, do you see value in that? Do you still rely on concepts or ideas or ways of thinking from engineering? I'd love to hear your thoughts on that, because it's a fascinating, to go out of the engineering space with that background.
I do. I think, most engineers tend to be more logical, and they seem to be comfortable and they seem to be very comfortable with data, right? So to a large extent, I think, drawing conclusions out of various data points in our work, day-to-day living, and kind of figuring out, statistically, does this make sense, comes kind of easy after an engineering degree or any mathematical or a science degree to some extent. And I think applications of those principles clearly kind of help when you're looking at various data points, making consumer-based decisions as well. I think that's my view.
Yeah, I've always thought too that my perspective has always been that the engineering mindset is sort of one of breaking down a big problem into little problems and figuring out how to take a big thing and make it digestible, and then solve those and then put it back together. And that's kind of an approach to solving problems generically that applies to, be it civil engineering, mechanical engineering, computer engineering, or just like business. Kind of works the same way.
Correct. And the other half also is like, I think engineers are kind of built after 4 or 5 years. They're built to build stuff stage by. They know how to take from one stage to the next stage. So I think when you're building products, even in the financial services industry, it comes very naturally to you in terms of how do you take a concept and kind of build it into something.
Yeah, that's great. Well, let's use that as a transition point to, I know you said you kind of spent some time at Citi is kind of when you first got into banking. And my understanding is you were kind of in the personal loan space and a little bit in the digitization space. Tell me a little bit about what you were seeing there and kind of what the big priorities, like what were the trends you were chasing or trying to get ahead of when you were looking at that space?
I mean, actually, I started at Citi in the credit card space. So,
as one does.
As one does. And pretty much in risk, a couple of different jobs in risk and decision sciences, then the digital online space. But predominantly, I think, half my time in Asia and half my time in the US, I was running, consumer credit card businesses, which kind of by itself gives a lot of flavor and understanding, and somebody who likes the business kind of gets to know how consumers
Mm.
behave, how do they, what are the products that the I would say the consumer offerings within the credit card products that consumers will like or dislike. So you kind of build towards that, and it was later that I actually started adding. When I went to Asia, I started adding both personal loans as well as credit cards into the same platform, because Asia has a very large lending platform for city as well. So I think the business is designed in a way that where lending is a complementary product to the credit card transaction uses space. So I learned kind of both of those and kind of managed both of those before I came back here.
Interesting. And I mean, we were just talking the credit card space is interesting because as we find ourselves likely facing a rising rate environment for a while, it's one of the few businesses that is floating rate and therefore can maintain some sense of margin even as the cost goes up. You kind of pass it on to the consumers, which I think is going to be a challenge for a lot of financial institutions, given they have more traditionally fixed rate products, often of longer duration, that end up with them kind of having costs out of whack with the interest rates they're charging as rates rise. I'm not a macro predictor, but I don't think it takes a magic 8 ball to figure out that that's probably something we're likely to see in the over the medium term.
Absolutely. Yeah, absolutely. But I think also as the rates go up and credit card rates become kind of high, I mean, it's in the transition right now. There's also an opportunity for personal loans to take over and provide a better rate. I mean,
Mm.
assuming that you can get cost of funds in a reasonable space.
Yeah,
But
that's
to
a
the previous point,
yeah. Go ahead.
sorry, go ahead.
No, please.
No, to the previous point, actually, there was one crinkle in Asia which I thought was worth mentioning.
Mm.
We would give credit cards, but we could say that half your lines could be used for personal loans. So people could either
Oh,
borrow
interesting.
money or they could use it as a
What
yeah,
did you see about behavior there? I'm always, one of the questions I get asked is what's driving personal loans as a category. I think it's also similar to this adoption we see of buy now, pay later, and like what kind of buy now, pay later in some ways was a solved problem for many people. Like I had a credit card that worked pretty well everywhere I wanted to
yeah,
go, and I could buy now and pay later.
yeah.
And yet there seems to be a trend towards these buy now, pay later products. And I'm curious if you saw anything in that utilization of the personal loan versus the revolving credit on the card that gives you any perspective on what you think the consumer trends are and what their consumers are really aiming for when they use those different things. It's really interesting to have half your line available as a non-revolving, more of an installment
And
product.
no, I think there are people who, I found, that tend to borrow on the credit card, and there are people clearly who are transacting on the credit card,
For
right?
sure.
So the occasional borrower will probably more lean towards buy now pay later kind of products, right? And the occasional borrower doesn't mind if they want to put a loan on their credit card for 6 months or 12 months, because they have a specific need and they don't mind paying a couple of percentage points extra, but known for a fixed rate. Those are the kind of people we were giving actually transactors an ability to borrow on their credit card. So that
Mm.
kind of paved the way for. I think it's a similar trend that you're seeing in buy now pay later as well. They tend to be, in my opinion, they tend to be people who normally would not have taken advantage. They would have paid off their
Hmm.
credit card bills after 30 days, but now they get an opportunity to pay it off over 4 months. So they say, why not, right? It doesn't cost me anything. So,
Yeah, yeah.
um, and whether the question, whether they really buy more than what they tend to buy, which has to be validated. If I never would have bought it, but now I'm going to buy it because there's buy now pay later. That's a question people have to answer.
Yeah, I mean
And
that's
is
the
it?
that's
And
the
the second,
that's the sales pitch from the buy now pay later guys to merchants, right? Is like increase conversion
correct.
rates, increase average card value, average transaction size, kind of drive a little bit more spend, which is really
But
interesting.
is it a self? Exactly? But is it a self select for people who will have trouble paying it off? That's another question that has not been answered, right?
Yeah.
Um,
Well, that is
but
that's I think an open question right now is what's going to happen to delinquencies and should these things be reported and how does any lender get a good picture of your debt load if a bunch of it is
correct,
in non-reported buy now pay later 4 month
correct.
kind of things. And I do think to me there was
Yeah,
I'm curious your thoughts, this interesting delta to your point about the transactors who would borrow with the line, this sense that some consumers want to they want to use a credit card to transact. You see this somewhat in the shift to debit cards among younger generations that don't really want to borrow what I'll call accidentally by
Yeah.
just swiping the card more, but that they want to be intentional about when they're borrowing, how much they're borrowing, and clear about the repayment terms, which a credit card,
Yes.
not to be rude to the industry, but it
Doesn't.
muddies it, right? It's like $25 minimum
Yes.
payment. Well, how long will it take me to pay it back like that?
How long?
We
Yeah,
don't know. And
exactly.
so it's very unclear. And I think for the consumer that's looking for clarity, buy now, pay later said, yeah, when you want to borrow, understand how much you're borrowing, how long it will take to pay you back, what it will cost, even if that could be zero in
Yeah.
certain cases. It can be for some of those players, they do interest bearing, like real cost borrowing now, as well as the buy
Yeah.
the paying for. But I'm curious, do you think of that as a secular trend where consumers are looking for a little bit more clarity and purpose, or like, let's say, intentionality behind their borrowing decisions?
I think so. I think, I mean, when I was at SoFi, clearly those, the target segment at that for that company was clearly people who didn't like largely the big banks the way
Mm-hmm.
they gave out credit cards, right? So they wanted control, largely wanted to have the ability to say, how do I spend, right? So debit cards was clearly something that I think appealed to them. But if they did want to borrow, I think they wanted to know I can pay it off in 12 months or 24 months or 36 months. So I think there's clearly a segment of people who, if they want to borrow, they want to pay it off very clearly.
Mm-hmm.
These were people who had student loans that were not paid for 5, 10 years, right, for a long period of time, and they couldn't see how it could be paid off. So I think if you give people the ability to see how soon they can pay off with fixed payments, there's clearly a segment of people who want to get their finances under control. Now there are people who can spend 3, 4, 5 cards and they have it under control because they know what they're going to spend and they're going to pay off, right, if they have the cash flow. But if the cash flow is tight and they want to spend but have the ability to borrow for a certain period of time, I think supplementing it with some sort of either buy now pay later or personal loans can help,
Mm-hmm.
right? That's
Yeah,
because if you borrow on a credit card, it's as you said, it's a little difficult to figure out when you're going to end up paying.
yeah. I mean, that's I think what's not everybody understands, but like 70 or 80% of the personal loan business, at least for most of the large platforms, is kind of consolidating multiple credit cards and outstanding payment amounts that are not able to be paid off in a short duration of time, 10, 15, $20,000, where it's not, hey, over the next
Correct.
2 months, I'm going to cover this. It's like, hey, this is small thing.
Correct.
So
Correct.
there's clearly some desire when you really have borrowed, maybe accidentally, more than you can pay off in a short
Maybe,
term,
maybe.
but to move that into something that's more understood about what the plan is. Um,
Yeah.
I am curious.
I mean, we
Go
used
ahead.
to go ahead. No, no. There was an anecdotal side point where we used to ask credit card consumers, do you borrow or do you transact, right? And majority of the people said, I don't borrow. And then we would go into the records and see almost 50% of them are actually carrying a revolving balance.
That's
So
fascinating.
I think it's also people's definition or perception of whether they are borrowing or not on a credit card, right? So to a large extent, I think people either don't want to associate it knowingly
Mm.
or they don't know that they're actually borrowing on a credit card.
Yeah, that's interesting. So, talk to me a little bit about you shifted from Citi to SoFi, and you're over at SoFi. We're running. I understand the personal and the student loan space. What were the opportunities? I mean,
Yeah,
it's SoFi to me is a interesting. Um, I
yeah,
think compared often to like marketplace lending companies, but really is more in my mind of a challenger bank that started not with a deposit product, but with a lending product, but really viewed to become a primary financial relationship with their customers. What was kind of your vision of the gap in the market, or the thing that wasn't happening that was driving SoFi's success? What were you guys? What was your perspective? What you were aiming for there?
I mean, to be honest with you, I think this was before the time I joined, right?
Mm-hmm.
Student loan and student loan refinance was largely being handled by banks, and due to regulatory changes and also a lot of issues that the regulators found with the banks just dropped the entire student loan sector, and there was a singular opportunity for somebody to come in and take that space in terms of refinancing. And I believe SoFi took that
Oh, they absolutely did. And
opportunity.
I always found it interesting that
Uh,
I feel like SoFi realize that the federal government's like upside down on underwriting. I mean, they're sitting there going, we charge you more for an MBA than an undergraduate loan. And from a public policy point of
Exactly.
view, it makes sense. From a risk point of view, it really doesn't.
It
And
didn't.
there was an arbitrage
Right.
there to say, hey, the risk is mispriced in substantial ways. Now it's not very high yielding, so you've got to have an efficient market to execute this vision. But there was an arbitrage in the just fact that the risk was mispriced between different kinds of loans because of the way it was and the purposes for which it was underwritten by the government.
Right. I think it was, that's what I said. I think Mike Cagney and his team kind of clearly understood
Mm-hmm.
that side of the opportunity. And then if you keep the cost low and keep it completely digital, even though the margin could be less, and the student loan in the United States is about $1.6 trillion. So it's a very big market. So if you get a large volume, even at smaller margins, you could make decent money.
Mm-hmm.
So that's kind of I think that's how the opportunity came into being. And I think after I joined and was managing business, we very quickly added, whether it was money or
Mm-hmm.
expanding the invest business, crypto, and adding a platform for insurance. A lot of things was done across the company that actually made it a much more diversified business.
Yeah, I mean, aiming to
So
solve quite a wide variety of financial needs for the consumers that were there,
exactly,
not just as many of the fintechs
yeah,
have stayed a relatively focused on one or two products. SoFi
narrow,
has been one of the kind of leading examples of a real broadening of product portfolio facing consumers, which is
yeah.
really interesting. And I guess the focus is still on a category of consumer that is seen to be somewhat underserved or poorly served by the current market that there's an opportunity for.
Yeah, I think it's a mix of one, underserved, and two, uh, people who maybe slightly younger, but new to financial services, who didn't understand
Mm-hmm.
the complexity of the banking side. But this made it very easy and simple for them to take on. So it's a long term play, quite
For
honestly,
sure.
right? Having student loans, which they know very well, and if you get student loans under control, can you save your money, and can you then get a credit card? And then you get your pet insurance, or whether you can get your life insurance, and all those things follow as you go through one by one, right? So I think that's the path to some
Well, the
extent
student
SoFi
loan
went.
is such an
uh,
obvious starter product for a young kid. If you're looking to attract the
right,
20 something, most everybody who
right,
graduates college does so with some amount of student debt,
have something.
right? And that's
Exactly.
not, any negative sign about your behavior or decisions. It's just the reality
No.
of how we fund college in the United States. And so
Exactly.
I guess that my
Exactly.
question on that
Yeah.
would be, so it's a very natural, like, hey, this is the first thing you're going to need, but then you're likely to buy a car, you're likely to want a credit card, you're going to get a retirement account, you're going to buy a house. Like,
Yeah.
we can start you off and build that relationship. So I guess the counterintuitive question is, why do you think the banks pulled out of that? I mean, it's such for most banks I talk to struggle with the how do we bring in the young consumer, right? I need more 20
Yeah.
year olds, 22-year olds, 25-year olds coming into the bank because my current population every year kind of ages and gets older. And I got to refill the younger folks. And
Yeah.
yet they're pulling away from such a natural entry point for a younger consumer. Why do you think that happened?
I mean, honestly, I don't have 100% answer, but I know that, for example, at Citi we had a student credit card, which
Mm,
was fantastic. Didn't make money, but it was an entry point to get into all other products and then get into other credit card products. Here, I believe, and this is what I had read up or I kind of searched. One is, I think there was a little bit of the regulator saying, your relationship with the universities was not, it
mm,
shouldn't be like that. It's so there was a few of those, with the banks having lending through financial institution. And then second, the margin was also not that big in student lending, right? So when you have a large infrastructure and you have student loans where the margins are thin, but then a lot of regulatory stuff comes in place and it increases the cost of operating it. It's a natural decision to say, is it worth being in the business? So I think the transition to a digital platform where it makes it very easy and simple and transparent for the consumer, and still reduces the cost, was an immediate offshoot of the regulatory changes, is my
hmm
guess.
That makes sense. So the other area I wanted to kind of dive in our discussion was like, what are the trends you see or the interesting products? I mean, personal loans has been this really interesting example of a product
Yeah.
that's kind of taken off since 2007, 2008, where it kind of almost didn't exist at that time as at any real scale or
Yeah,
volume, and
yeah.
it's really grown. And then there's things like buy now, pay later, and crypto, and like all sorts of new financial instruments that are that are kind of growing and becoming real meaningful parts of the ecosystem. Do you see, threads running through those or other areas? I'm just curious your thoughts on what are the things you're focused on that are kind of the new products that are out there, that represent kind of a change in the traditional status quo of what the financial services industry is offering to consumers.
I think, again, this is just a personal hunch. There will be different versions of personal
Mm,
loans, in my opinion, right? So I think personal loans is here to stay because the digitization as well as the fintechs will make it very easy for people to
yep.
get this, right? So more and more people will enter, and more people will provide a flavor, whether it's at point of sale or whether it is buy now pay later, or whether it is different way of consuming the same loan. I think whether it's with merchants, without merchants, doing on a credit card, separate from a credit card, there will be different versions of that will flavor out. And I think that's a good
Mm,
opportunity because, especially for the earlier point that you raised, where people may not want um, to take credit cards anymore. They would rather spend on debit card because they know they have the money. But then if you can provide this control mechanism on a credit card with some means to for the consumer to kind of decide, I have a $30,000 line, how do I want
yeah,
to
yeah.
use it, right? It might be a different flavor, right? It might be a different way and a concept of how do you drive that, giving control as well as giving the ability to finance at a particular price and not shooting off, in a variable rate which can go on
Yeah,
increasing,
yeah.
for example, right? That's one area that you can think about. The other is there are macro factors that we see. One is clearly uh, the solar component of on whether it's
Mm,
in housing or in
yeah, yeah.
cars, right? And I think if more and more people are going to have their homes with solar power, it does require a chunk of change in terms of borrowing or
For sure.
financing that part. um, and I think with costs of heating or gas, which may continue to rise, I think more people will move towards this macro trend. And I'm seeing that in my own development here, that people are very rapidly shifting towards a Tesla or other
Hmm.
um, uh, EVs, as well as actually electrifying their home. So that provides a big opportunity, I think, quite honestly. It's another form of actually a loan, but it's more securitized. But it's an offshoot of a personal loan combined with a securitized loans, I think, to some extent. Um, the house being the asset. um, and I think there could also be offshoots of lending with if housing values really go up. Is there offshoots of using housing values as a means of spending within a certain limit, um, where you're not borrowing at a huge rate, but borrowing within a certain better rate, but still gives the flexibility of a credit card, for
Hmm.
example. Um, so I think, again, these are all not fully flushed out, but these are kind of drawing board kind of phases. I think there are fintech companies already evaluating credit cards on like a home
Hmm.
equity line, but rather as a credit card kind of
Yeah,
tools,
yeah.
right? But solar, some of the companies have done very well.
Yep.
They have already started, getting on that trend. But I think the lending side, the personal loan side, still has some room. The jury's still out on buy now, pay later, and see how those things stand up
How do you think? I
once the
mean,
rates go
how
up
do you
and
think about buy
everything.
now, pay later is different than? I mean, on some level, there's the no cost version, the pay in four, but on some level, it's just a personal loan on a shorter duration,
It's
and I would think with some
exactly,
really just with a merchant incentive, right? Like the reason it's interest free is because the merchant's paying a fee on the
it's a
back end,
funding.
right? I mean, the lender's making
Yes,
making margin. They're
yeah,
just doing it on the lender on the merchant side.
yeah,
So I'm kind of curious if how you think
correct.
that plays out because it does. On some ways, it feels like a different product, different distribution. But to your point, it's kind of just a different flavor of the same thing in many ways, where it's not that
No,
different.
it's. I mean, I kind of segment it into two pieces. One is if it's basically it's a lending
Hmm.
product, right? So if you are providing a lending product before to these consumers, but now you're providing a different flavor of saying you can borrow for 4 payments or
Mm-hmm.
6 payments, whatever it is, right? And pay it off with zero interest. That particular transaction, we didn't provide it on a credit card or some other loan, right? A short term loan. So I think that's good. In a way, you're giving to the same people. But in the other category, where is it really people that you wouldn't have qualified before are now qualifying for a 4 payment, 6
Mm-hmm.
payment kind of thing? That's a little bit questionable. I mean, do you really think that the underwriting skill set would be that different
Mm.
for somebody to borrow or 4 payments? And that, that time will tell, right, whether you're actually bringing in incremental people who wouldn't get a loan before or who wouldn't get a credit card before, who
Well,
could
importantly,
borrow.
who wouldn't get a loan or
um,
credit card and will pay back. uh,
and will pay.
yeah,
That's
yeah.
what I'm saying. Will they really pay back, or is it really truly incremental good people who, credit quality wise, who will actually pay? So I think those are the two differences,
Mm-hmm.
right? If there are more people coming and borrowing in the buy now pay later who didn't borrow before, that's
Yeah,
a good thing. Although I'm not 100% sure on that second
yeah.
part.
We'll see. I've been asked what I think buy now, pay later means for personal loans and the kind of fundamental. I love Elon Musk's get down to fundamental physics, and I feel like the fundamental physics of this is if buy now, pay later is increasing the overall debt leverage of the American consumer, and personal loans are generally a way of
Yes,
consolidating over leveraged consumers, then it's
consolidating.
hard to see how it's a negative in the long term, right? If people really are buying more, then they're increasing the total debt burden and products that help them spread that debt burden out over longer periods of time at lower interest rates would have to seem like they're not threatened by an increase in leverage. So we'll see. I think it's interesting.
It's interesting, but the product itself, right? You didn't have between a loan, you didn't have a short-term loan for 2 months, and you didn't have credit card that allowed you to make 4 installment payments. So the product itself is a new category, which I
Mm.
agree, right? So any credit card issuer can shape it into their credit card by all means, right? So the question is really, is there a big enough industry to stand by itself and create these opportunities with merchants? And if merchants are willing to fund it, it will
Yeah,
stand, right? If the merchants are not willing to fund it, then it won't stand, because eventually the risk will creep up and somebody's got to bear the
that's right.
risk.
Somebody's got to get paid for the risk, and that cost is going up as interest rates rise.
Exactly.
So,
Exactly.
last topic I wanted to dig in on because you mentioned crypto as one of the things I think you guys had looked at SoFi, and I'm curious. It's hard to talk about new consumer products and not talk about crypto. I feel like every podcast and an article has to mention crypto somewhere. Do you have a take on where crypto
Yeah,
is
yeah.
at, or what's happening, or what you think is going on in either the crypto or the Web3 space these days?
I mean, honestly, I don't know how to classify it,
Join the
and I
club.
have to be honest. I don't know whether it's an asset or whether it's something else. But what I feel is, this is the way I look at it. Right? If 10 years ago, if somebody had asked, do you will there be so many electric vehicles on the road? People would have said
True.
no, right? Um, and today people are buying, without thinking. I mean, very easily, people are, I see hundreds of Teslas around, right? So is the one area where crypto is really helping, I think, is in international
Mm.
payments, right? Where you have where you're paying a ton of fees on both sides, whether you're originating in a bank and the person who receives it,
Yep.
there's a lot of cut being made. I don't want to name companies. I mean,
It's very
there are
expensive to send
there are
money
companies
overseas, particularly
specifically.
small amounts.
It's very expensive, right? There are banks, non-banks, who, especially, if you have short term. When I was in Asia, there used to be a lot of migrant workers who used to come to Singapore, and they used to work. They send money across to multiple countries, across Southeast Asian countries, and it used to be very expensive to send the money, right? So if you use crypto, and if you had a fixed exchange, I mean, that can reduce the cost of sending money very easily, right? I mean, it has a
Mm.
definitive value. And I also hear friends who are using it in places like Argentina right now,
Yeah, yeah.
and Venezuela, and places where they can exchange a crypto, a Bitcoin, real time when they want to buy their groceries, right? So I think there's definite value, but I feel more like the first example I gave. 5 years from now, if you said, if you had just bought small portions of crypto, or a Bitcoin, it would be worth quite a
Hmm.
lot of money. Maybe yes. So I think, if you have discretionary money, maybe own it a little bit, and kind of see where it takes you. But it is volatile, right? So from a personal point of view, from my point of view, I think, if I would have, didn't mind losing like $100 a month or something, then I would have put it and kind of see what happens
Yeah,
after
yeah.
5 years. But there's all these people from Jamie Dimon to Berkshire who have different points of view, and of course the younger people always like younger generations kind of tend to like. That's why I think SoFi introduced it at that time. I mean, they're very positive, and there's a huge population that is extremely positive about
Yeah, yeah.
crypto. So I think only time will tell on the end use, right?
Yeah,
I
it's
think.
certainly, if nothing else, I think for a banker, you've
Yeah.
got to look at it as an asset category that your users are interested in. And just like any other asset category,
Correct.
as an asset manager, you would want to allow them to enter or exit. It's got to be on the list. Now, the question of whether there's more interesting use cases, whether it becomes a bigger asset class than cash or fiat currencies, is a whole different question. But certainly, we're there.
No, but if I buy a dollar, coin, and I transfer that dollar coin, and it has the same value in Thailand tomorrow, or in Venezuela, right?
Mm-hmm.
Then it's really worth it, right? At the end of the day, because I
Yeah,
don't lose anything in the exchange, and I just transfer it to somebody, right? I see tremendous use of that, but probably banks will make less money, right? So as a banker,
but
you're making money on currency exchange,
as long as the Ethereum
right?
gas fees
So
don't stay too high, then it'll be cheaper, and the banks will have to earn less money. But we'll we'll
that's
see
right.
we'll see if that remains
That's
true.
right. Yeah. Yeah.
Well, Anand, I have the same three questions
Exactly.
I ask
Exactly.
everybody at the end of this podcast, and I'm going to kind of throw them at you now. Would love to get your answers. The first
Sure.
one is, what's the best piece of career advice you've ever gotten?
The best piece I would say is, when you change your jobs, make sure 50% of the job you already know,
Okay. Does that mean 50% you
and then
don't?
50% is 50% you can learn. So don't go beyond 50% of something that you totally don't know in a new job, right? The reason the gentleman gave me was that you can still execute on the 50% that you know very well while you're coming
I
up the
like
curve,
that.
right? Uh, right. So that I think that helps you frame whether this is a job that you should get into. I mean, it might still be okay to get into. You might be a quick learner, but your probabilities of failure could
Mm.
be high if you don't know much about that job in
Yeah,
terms
but
of
there's
transitioning
also
to
the opposite side,
a
which I
new
see
role.
is, you know, the other side of this. Don't take a job where you know 100% of what to do, because then you're not learning anymore. You're
Yes,
just,
exactly,
and that's
exactly,
probably not the right
absolutely,
growth.
absolutely. I'm assuming that yeah, I'm assuming you're going to a new job because you can do more, you can learn more, you can do something. But if you're suddenly going from lending to crypto and you're going to build something in that space,
That's
that
just
could
the
be
50. I've heard the
risky.
concept, but the 50/50 breakdown is new. So that's interesting. Know 50% and don't know 50% of what you need for a new job. That's an interesting concept. A second question. You've had quite a career in the consumer lending space. So you probably have an interesting answer. What's the best piece of advice you've gotten about the consumer lending space generally?
I think anybody who deals with consumer space in general and consumer lending needs to understand consumer
Mm.
behavior, right? You can always design products and services around the consumer needs. At the surface, everything seems very simple. I'm just going to borrow, I'm going to transact, but you really need to know where do people shop, right? Do they, is a trend shifting online? Are they using different cards for shopping online versus physical? Are people working from home? What is their preference? What are the hassles? Uh, where are the roadblocks for somebody to make a transaction? And once you understand that, I think designing products and services, which are really
That
cool
feels to me like
assets.
the like a lending version of the don't assume people are rational, utilitarian, maximizing being. They're not. And if you assume that, like, well, we've got a 20 basis point lower rate, of course they would come here. Like, well, that may not that may not be right. That's not a good assumption, and it's easy to, particularly in finance, where we think of things as so number oriented, to get caught up in like the numbers.
we actually saw the if the user experience was very smooth, people really didn't care rates that much. Rate was a factor, but sometimes people take a higher rate just because it was much easier to accept and complete a loan,
Yeah, we
right, at the
found
end of
that
the
too
day.
for sure. That borrowers are both rate sensitive and what we refer to as effort sensitive. They will
Yes,
walk away, and to some
yes,
extent that you can see adverse selection in the effort bias because good borrowers are particularly effort sensitive in some instances, and so your
correct,
friction can be
correct,
not only negative
exactly.
to your funnel but negative to your credit performance because you have an adverse selection factor at play as
Yeah,
well. All right, my last
yeah.
question: what's one bold prediction for the future? I
Bold
mean,
prediction
bold
for
is in
the
the eye of the
future.
beholder, so you don't need to feel
I
too
think
intimidated by that word. But
I, the beholder. When I look at my kids' generation, they just don't know what a bank branch is. Quite honestly, they've never been in one. I don't think they'll go in one. So I don't see in 15, 20 years. I don't think banks will have any branches anywhere
all right,
for whatever
the
reason.
the end of the bank branch. That I'll give you credit for bold. You met the bar of the assignment. Good job. Bold prediction: the end of the bank branch. Well, Anand, thanks for joining us today. This
Yeah.
was a great conversation, and I appreciate your taking the time and sharing your insights and perspectives.
No, absolutely. I enjoyed it very much. Thanks to you and your team for putting this together.